nobody's pricing in sort of a worst case scenario yet, right? That oil could hit 130 or that the war could broaden and become regional. They're actually thinking, look, I think Iran gets the message, right? They're going to come to the table. We're going to see a negotiated diplomatic solution to this. Agreed or not?
No,
or is that too optimistic?
Absolutely agreed. That is what's being priced in. I think what's being priced in is a de-escalation from here, or certainly not a significant escalation by any means. In our minds, it would be more sensible to price in an escalation, not because we believe that's a base case, but if you look at where equities are trading and the risks that can lay ahead, right, it's very likely that you'll have a better opportunity to buy the market in the coming months or quarters than you do today, particularly for long-term or patient investors. There's not necessarily a reason to jump in today, given the landscape that you see ahead and the prices that you're having to pay. Yeah,
I hear you. I mean, if there's an opportunity to get in at a more attractive entry point, why not? Sherry, come in on this.
Yeah, and this is something that I wanted to bring up in our chat earlier, Marty, because when we're trying to understand what's going to happen with the trade war and all these tariffs, oil was actually the space where investors were getting some comfort from, that it's not going to lead to some crazy level of inflation because oil prices is low. Well, that's not going to be the case, because that's actually the one part of the markets that's pricing in a lot of geopolitical premium. So could that change the market's view about the Fed, about central banks around the world in terms of how ready they are, well, maybe not the Fed, but for the rest of the world to go easy on the monetary policy as well?
Yeah, I think it's a great question. I mean, if you kind of take a step back and look at our view, we have had goods inflation, for example, in the absence of tariffs increasing, right? Goods inflation has been decelerating over the past couple of years, kind of working through the supply side shock that we all have experienced through COVID. That being said, we've had an increase in tariffs. No one knows at this point kind of what the magnitude or the timing will be of the ultimate increases in tariffs globally. But now you obviously layer on an additional shock. And I think to your point, Sherry, I mean, the market had been pretty sanguine about oil prices until the recent events. And I think that does introduce a significant layer of uncertainty, as I mentioned, right, that isn't being discounted in markets, and it introduces a significant increase in complexity if you look at the position of central banks and decisions that they need to make in the coming weeks and months.
And Brian, how do you marry the two? Potential supply shock coming from the Middle East and ongoing demand shock because of artificial intelligence. And is this really the point where traders and investors need to go find some great energy names to be long on?
I think so. From our standpoint, it's a point in the market cycle where you need to do a handful of things. You shouldn't be building portfolios that are positioned for single outcomes, because predicting a single outcome at this point is extremely uncertain. Investors should be building portfolios, right, that in our minds are defined as all-weather portfolios that can do well in sort of any environment. And that's investing in companies that have pricing power, right, that will be able to weather an inflationary storm. It's also having energy hedges within a portfolio, which for us is about 10% of our multi-asset fund, which is, I think, a reasonable place to be, significantly higher than index weights, as an example. So I think investors need to focus on making sure their portfolio can weather a storm, right, wherever that may come from, whether it's from oil price shock, whether it's from tariffs that are either higher than investors are sort of currently pricing in, but ultimately building and focusing on companies that do have pricing power, that are fundamentally strong, and ideally trading at more reasonable valuations than the market overall.
Boy, I tell you, I mean, that sounds like your screening is getting even tighter, right? So are you finding companies like that?
So it's a great question, Mark. I mean, obviously, the tighter you make the screen, the harder it is to find these companies. And I think to your point, I mean, at this point, we have about 30% of our multi-asset fund in cash, right? For the reason that we expect you'll be able to buy the market.
30%?
Correct, correct.
Okay.
I mean, we expect to be able to buy the market at better prices going forward. That being said, within equities, which is about 50 to 60% of the portfolio, right? Energy does make up about 10% of that. And there are companies within that sector that do continue to offer good value. Companies like SBM Offshore, for example, which is one of the global leaders in manufacturing, maintaining, and managing FPSOs, these floating production, storage, and offloading units for deepwater offshore oil drilling. It's a company that continues to grow earnings, right, at double-digit rates, trades at a 10 times multiple instead of the 20 times multiple that you would see on average in the US and even mid-teens in Europe, and continues to pay a 4.5% dividend yield. So there are companies that investors can find that offer growth at good value and pay steady income.